Hello, everyone. Welcome to our monthly webinar. We will start here in a few moments. DJ, how are you today?
I'm doing great. How are you?
I'm good. I'm enjoying a beautiful sunny day on the Oregon coast.
Good. Glad you got the sun. We got it over here.
All right. There's some new things happening on Facebook. So.
Oh yeah, they changed the Facebook Live deal. I saw that.
I see that. All right, here we go. I think we got it.
Yep, there you go.
Okay, so welcome everyone. So let's warm up the chat. Let us know where you are tuning in from in the chat feature or in the comments. If you're listening to us on Facebook, we'd love to know where everyone is tuning in from. And I will go ahead and share my screen here.
Got some Salem, Oregon, Monmouth.
Excellent. All right, well, don't be shy. So if you have any questions as we go along today, please feel free to put those questions in the chat feature or the question and answer feature, the comments, and we'll make sure to get to those either during the presentation or for sure we will stay at the end to make sure everything is answered for you. So today we are here to talk about revealing the retirement trifecta. Isn't that just a really cool statement?
It's riveting.
Well, stay tuned because no matter what stage of life that you are in, whether you are planning for retirement in the future, whether you are in retirement now, or maybe even haven't even thought about it, we're gonna inspire you to consider all different aspects of retirement. So we're excited to present this to you today. First, I will start with a little bit about Financial Freedom Wealth Management Group. So if you are new to us, welcome. We were founded in 2000, so over 20 years ago. We are a comprehensive wealth management firm that is really committed to helping our clients improve their long-term success and pursue financial freedom. I'm going to talk more about financial freedom, but we really believe in financial freedom. And we also believe that everyone can have it. And so we're going to talk about that. Who we serve: retirees, pre-retirees, those that are just getting ready for retirement, business owners, and also we call it people in transition. So usually there's a triggering event. So it could be you lost a job, or you went through a divorce, or possibly you lost a spouse, or maybe a parent. When those things happen, it's important that you work with someone that can help guide you through that transition. And we do some of our best work for those scenarios. I will talk about our core values, which just really drive our company. It's what we stand for: treat all people with respect, never compromise our integrity, delight our clients, and embrace our team culture. Our commitment is to care deeply about you and your financial life. Our services include not only investment management, retirement income and distribution planning, which is what we're going to talk about today, tax reduction planning. Who doesn't want to pay less in taxes? We'll talk about that today as well. Family, wealth, and legacy planning. We love to put on educational events much like this one, and then also consulting services for businesses, helping business owners create their exit plan. I am Julia Carlson. I'm the CEO and founder here at Financial Freedom Wealth Management Group. And my only career has been in financial planning. I was blessed enough to find this career when I was a teenager, actually. I started in the business when I was 19, worked for a local bank, and then transitioned and started what is now Financial Freedom back in 2000. And I have a passion for helping people with their money to simplify it and provide inspiration that we can all create financial freedom and financial independence in our lives. Here's a picture of our lovely family. My oldest daughter is actually graduating in a couple days, so we're excited about that. And then my two younger ones are growing up quickly, are 13 and 11.
I love the hats, Julia.
That was a fun photo shoot we did with the cowboy hats. My girls are very much into horses, so it's kind of bled through the whole family. And DJ is with us here today. Welcome, DJ.
Hi.
DJ is a wealth advisor with our firm, and he's also our portfolio manager, which he is helping manage over 380 million, 390 million. We're almost to 400 million in assets that we manage. And he leads that team. He is dedicated to finding the best investments for our clients, and then helps design our customized portfolios. He's just passionate about serving clients across the nation and really embodies that goal of helping others create financial freedom. He is a Oregon Duck. He received his bachelor's degree from the University of Oregon, where he actually focused in economics and business. So we are excited to have him. Tell us about who's sitting on your lap here.
So this is Oliver, or Ollie, my 5-year-old son. He's the best. I love him. And yeah, people say he's like a little mini me, which I do see that.
Yes, I see it too.
And we got to go Ducks in the chat. Go Ducks.
Excellent.
And Julia, I know you said this has been your only career. This has actually been my only career as well. Not quite as long as yours, but I hope it is my last as well.
Yeah, it's fun to be able to find this career early. And a lot of what we do, I mean, there's so much continuing education in our business as things constantly are changing. And so it's like we can be students of the markets, and it's just amazing to see how the experience happens over time, which hones our craft. Yeah. Well, good. Well, we will hear from DJ when we talk about investments. So we will come back to you then. I also wanted to show this great picture of our team. We just recently had our pictures redone here. So we have an amazing team of 6 wealth advisors and 8 support staff here to serve you. All right, well, let's transition here. Let's think about it. I think a lot of times we're so much in the day-to-day that sometimes it's hard to step back and look at things. So if we kind of step back and look over these last 18 months, there's been a lot of stuff happening. Americans are experiencing a lot of confusion, pain, frustration, socially distancing themselves from others. It has been a year of unprecedented events happening. There's been people that have gone on unemployment thinking that they would never be on unemployment. There have been losses of incomes, losses of spouses, losses of parents. There's just a lot of disarray that has happened. Half of all retirement plan participants have less than $10,000 saved for retirement. Can you believe that, DJ? That's a crazy statistic.
Yeah.
Yes. And I don't believe it's because they're lazy, if you will. I think a lot of this comes from not understanding investments, not understanding how to actually just get started to become an investor, and just not able to make those smart decisions. You know, investments can be very confusing. There's also, I feel, a disconnect between what is happening in our small communities, in our towns on Main Street versus what's happening on Wall Street. You know, I've had several client reviews this week, and they are pleasantly surprised at the amount of gains in their portfolios. Like, you wouldn't expect that we could have a year in the markets that we've had with what's happening in our main streets, with small businesses struggling and not making it. I think what this has taught us that we have to be investors. We have to get educated and understand what's happening in these markets, or align yourself with someone that can help you. And that's obviously our goal, is to help you navigate all of this confusion and overwhelm, if you will. So when we are in a confused state, that's what I see in this bottom right picture. When we are feeling overwhelmed or confused, you know, what happens? We do nothing. We freeze. We procrastinate about making money choices. And I don't feel it's because we're lazy. I think it's just because we don't want to make those mistakes around money. Maybe you have made past financial mistakes that makes you cautious, or maybe there's unknown about what's going to happen in the future. But freezing and doing nothing is not the right course of action. So today, our goal in this webinar is to help you understand your choices, and then you get to decide what is best for you. And our job is to kind of, again, keep this simple. Complexity, we know, is the enemy of making things happen. And so our hope is that we kind of break this down in a simple way, and then you can take from it the information that works for you and then go and apply it. Because in that application is when you will be able to transform your financial future and really get to, whether it's retirement, which we're going to talk about, or whatever compelling future you want. Oops. Okay. I hope I didn't. Okay. So let's talk exactly about retirement. The first thing about retirement is I want to know, what does retirement mean to you? This is not about me, not about DJ, but it's only you can design your compelling future and picture of retirement. And it has to be so compelling that it's going to pull you into it and keep you excited about that goal. So it could be spending time with grandchildren. That's very common. It could be keeping your body in the best shape, because without our health, wealth doesn't matter. You can have all the money in the world, but if you are not healthy, it doesn't matter. So reading, I love to read, but in this stage of life that I'm in right now, it doesn't happen very often. But I know in my future, when I think about retirement, I think about having time to read. What is something for you? So if you want to put it in the chat and be brave enough to do that, that would be great. Like, what is something that you're looking forward to? Or if you are in retirement, what's something that keeps you excited? Or maybe we're reopening again. We can start traveling and spending all the money we've been saving. What about for you, DJ? What's something you're looking forward to in retirement?
Golf, fishing, travel. I like reading. I like reading news. I need to get better at reading for fun. But yeah, just enjoying it. Enjoying life.
Yeah, very good. All right. Well, there's, I want you to really consider that for you. And then adding to that, when we think about defining your retirement, what will it look like? Another good question is, what's your perfect day? Like, if you could design your perfect day, what would that be?
That's a great question.
Yeah, isn't that fun?
Mm-hmm.
Yeah. And I think depending on what stage in life you are, I think a lot of times when we're in our 20s, our 30s, 40s, even 50s, we think about retirement being way off in the future. And being kind of irrelevant to our lives today. And I would say wrong. Others think that retirement could be an age, like, okay, I'm going to retire at 65 or at 67 when I get full retirement age benefits and Social Security. And that doesn't have to be true either. I think retirement is much, much bigger than that. And it really depends on how you want to design it. So I like to say it's not an age, it's a financial number. It's actually, when I think about retirement, I think about it as financial independence, because that's ultimately when you can decide what you want to do and design your life, not thinking about money. I think of Chandran. Chandran is the president in our company, and he actually started working with us at a normal retirement age. And he says, these are the best, this is the best career or the best job in all of his jobs, because he's doing something that he's passionate about. So it doesn't really have to be an age. It really is how you want to design your future. Okay, so we're going to start laying the foundation here. So before I reveal the retirement trifecta, let's talk about some steps to that path to financial independence. We call this the financial freedom way. Step one is financial freedom. We believe, like I said before, that everyone can experience financial freedom. You're only a decision away from it. So I'm going to go in a couple of slides here. I'm going to talk a little bit more deeply about that. Step two is a healthy money mindset. This starts by bringing awareness to what your mindset is around money. And then evaluating, is it a good one? Is it the one that you want? Or is it one that's left over from childhood and bad money decisions earlier on in life? You get to decide. And if it's not the one you want, then we got to figure out, how do we get to the healthy money mindset? We could do a whole webinar on that. So it's not going to be about that today. Step three is relationships and money. So finances can wreak havoc in relationships. It's one of the leading causes of divorces. Again, we're not going to go into that, but it's critical as you start thinking about your financial future and retirement. It's something that you do with your spouse, if you have one, with your partner. It's critical that you take the time to dream together and plan together. Step four is proper protection. So if you have other people that depend on you, you need to have a plan in place. It could be life insurance. If you have a younger family, it could be an estate plan to protect your assets and actually create that legacy that will go on for generations. So it's essential to do this planning, especially as you start building more and more wealth. Step five is value-based spending plan. This is essentially how you spend your money. And guess what? We all get to spend our money any way that we want. I like to say we want what we want. And how you spend your money will be a good indicator to show you what you value. So it could be travel. I love to travel. I love to go on vacations. I am investing in memories with my family, and that's important to me. So in retirement, how do you want to spend money? How much money do you need? We all get to design our spending plan, and it doesn't have to be restrictive. We don't have to use the B word, budget. Step six is getting out of debt. So debt is a trap. You don't want to get in that rat race and get stuck in there. So we help our clients create a plan to get out of consumer debt. You can have smart debt like mortgages, but it's important that you have a plan to get out of debt. And that following these steps will arrive you at financial independence. And that is building a future, and being financially independent just means that it's different for everyone. It's a different number for everyone based on all their desires. And so I think, what do you think of these steps, DJ? I think I think this is the first time we're kind of introducing this to our clients, and friends out there. So I just really feel that it just makes sense.
Well, I love that it's more than just numbers, it's like it's emotions and your mindset. That's a huge piece of it. So
it is. Yes. All right. Well, I love this quote by Napoleon Hill. To achieve anything, you need a burning desire. That is where it starts. I love this process. When we think about financial freedom, where it all starts, remember how I said it starts with a decision. It ultimately, that desire of wanting to be financially free, or apply this to any aspect of your life. You can apply this when I teach my kids things, a lot of different ways. But if we look at just financial freedom, it starts with that decision. It starts with understanding and knowing, why is that important to you, your individual decision. It comes from within. It creates this mindset that I am going for what I want. And here's the thing about the decision. It can only be, you don't have to defend that decision to anyone else. We want what we want, and it's only for you. But when you decide, it means to cut off all other options. So when we think about financial freedom, it comes just in that instant that you decide, this is what's important to me, and I'm going to go on this journey. And then following that decision, it then needs determination. So it's easy to do a budget or follow a spending plan for 1 month, but how are you going to do that over time? That's that determination. It's that commitment and dedication and acknowledgement when you get off track that you have to keep going. It requires new habits and behaviors to keep going. It's oftentimes training your mind that you made a decision and you're staying committed. What happens over time, though, you start gaining momentum. And in that momentum, you gain discipline that happens kind of automatically. It's hard to gain momentum, but it's easier to maintain it. And it's because it kind of becomes second nature at that point. And so once that discipline happens, that's where the freedom shows up. And there's actually a book that came out that says, "In discipline is freedom." And so I just really feel like if you see it kind of in this wheel format, you'll see and understand anything you're trying to learn, you can go through this format. I had an example. My husband and I were participating in a local Dancing with the Stars competition. And we had to learn tango, which is a very hard dance to learn. But if you follow this around, we made the decision to do it. We were determined to show up for practices and learn it and create new habits. It created new disciplines. We could do it almost automatically. And we actually showed up at the competition and we forgot the routine, but we could actually dance on the dance floor tango because we had done everything right. And so that essentially gave us freedom on the dance floor. I don't know if that's a good example, but I hope
think it's a great one.
All right. So hope is not a retirement plan. There are 35% of retirees today rely on Social Security alone. And the average Social Security benefit is about $1,200 a month. So that means a third of all retirees in our country are living on annual incomes of $14,000. So it's hard to live your retirement dream when you're that low of income. So we have to get empowered. We have to figure out this retirement game, if you will. And so that's how we came up with this. The retirement trifecta. Here we are. So here's the 3 aspects of this. First of all, it's a proactive accumulation strategy. So if you are now saving for retirement, we need to make sure that you are saving in the right way. So we're going to talk about that. If you're in retirement, it becomes about making sure that your distributions are coming out of your accounts in a tax efficient way. We have to pay attention to taxes, especially with the future of what most likely will happen with taxes. They'll probably go up. Do you agree, DJ?
I think so.
Yes. And then lastly, whether you're saving for retirement or in retirement, making sure your money's going to last the rest of your life and into the future generations, it's important that you have a smart investment strategy. You will be an investor for life. That is our hope for you. And so, but what you do in the accumulation stage is very different than what you do in the distribution phase. And we're going to talk about that. So let's dive in. Okay, so the first thing about whether it's accumulation or distribution is understanding the way that we save money for the future. Okay, there are primarily 3 different ways. You could call them buckets, if you will. That's kind of a neat way to think about it, that you can build wealth for the future. The first one is what I refer to as taxable accounts. So this could be your savings accounts, a CD, if you owned individual stocks or bonds, non-retirement. So this is outside of retirement accounts. You can own mutual funds, ETFs, real estate, investment real estate. That's all going to show up in the taxable bucket, if you will. These accounts, you either get a 1099 every year that there's reportable income from them, or if it's a stock, you invest in it and it grows. Essentially, you're not paying taxes until you have a triggering event. So until you actually sell it. So in tax efficient mutual funds and ETFs, you could invest in those and then not really pay taxes until you take the money out, until you sell the investment. It's a great way to build wealth for the future. You just have to make sure the funds that you're investing in don't have a lot of turnover. So we can, I don't want to get into the weeds, but we can help you with that. The second bucket is what we refer to as the tax deferred bucket. Another way to refer to these would be pre-tax. So in all of our retirement accounts at our workplaces, our 401ks, 457s, 403bs, a traditional IRA, you get a tax break for putting the money into the account. And it grows tax deferred. But when the money comes out in retirement, after most likely 59 and a half or older, you pay taxes at those tax rates in those days. So if you're in retirement, you'll obviously, and taking money out, it's today's tax rates. But if you're my age or DJ's age and you have 20 or 30 years till retirement, then we are going to pay taxes at those rates, not today's rates. But we're getting the tax break today for putting the money into it. And then tax-free is a Roth IRA would be an example of this. You don't get a tax break for putting the money in. So it's after tax dollars. You just writing a check and putting it into your account. So it's after you've been paid, but it grows tax-free, comes out tax-free, as long as you follow the rules. And here's the deal with all of these. What is the question we get all the time is, what is the best way to save for the future? There's no right answer. It really depends on your situation. But what I'm going to say is it's good to have all of these. So typically what we see is when clients come to us saying, I'm ready to retire, they have all of their money in the tax deferred bucket and hardly any in taxable or tax-free. That makes it very hard to escape taxes in retirement. So it's essential that you have not only investment diversification that DJ is going to talk about, but tax diversification, and understand how to create that nest egg for the future. So let's talk about the Roth IRA and really the power of a Roth IRA. There's two different ways to get money into a Roth. A contribution, which is if you have earned income, that's the secret. You have to have earned income, or your spouse has earned income, that you can do a contribution into a Roth each year. The limit currently is $6,000 if you're under 50, $7,000 if you're over 50. The other way to get money into a Roth is a conversion. And this is where you move money that is already in that tax deferred or pre-tax account and move that into a Roth IRA. Now beware, I'm going to come back and talk about these conversions, but what happens when you do that conversion? Any ideas? Yes, you pay taxes in the year that you do those conversions. So it's critical that you're doing them in a year that you have lower income, or you just have to manage the tax rates and tax brackets when you're looking at a conversion. When you're in this accumulation mode, the most important thing about accumulation is you just keep funding your retirement. If the market's down, you keep putting money in. If the market's up, you keep putting money in. Consistency and time in the market and investing is what will get you to that financial independence. So my dad helped me set up my first investment account when I was 17, 18. And I would probably, I don't know how many months, not very much, that I've missed between then and now of just completely putting my investments and saving essentially on autopilot, where I'm saving out of every paycheck and just going in there. It is important though to understand, is a Roth or regular better for your situation? So even in our 401ks, we have now our 403bs, options are now there to choose Roth or regular. So it's important you're choosing the right options and maybe even doing a little bit in both. Because the second bullet point, the 401k and the IRA are great statutory tax shelters, but it's important that you're not only planning for today, but into the future. And then as we have the senior generation, as they get older, what we're seeing in our clients is a lot of clients are inheriting IRAs. And there's new IRA beneficiary rules that you can actually roll them into your own inherited IRA, avoid the taxes up front, but then you actually have to take money out of those over 10 years or within 10 years. So we can help you design a plan that allows you to pay less in taxes over time, but almost redirect those inherited IRAs into your retirement. Okay, so let's shift into then the distribution phase. So as you get into retirement, now it becomes all about tax efficiency. And now I've built my nest egg. How do I start creating a paycheck from that nest egg in the most tax efficient way? So let's talk about a step back into history of taxes. If we look in 1918, the highest rate was 77%. Although that was for incomes over $1 million, which in 1918 was probably very, very few. But you can see over time how our top tax rates have shifted.
Look at 1945, 94%.
Yeah, that was what the World War, right? You saw the tax hikes after the war. Yeah. And what's going to happen after this pandemic? If you can't print trillions of dollars and not most likely have tax rates go up. So they're already talking about moving rates from 37 back to 39.6. But based on history, it could go way further, a lot higher than that. So that's why it's critical to think about taxes. So for 2021, these are the federal income tax rates and brackets. So on the left is single, on the right is married filing jointly. And what you would do is find your income on the right or left going up. So if I am married filing jointly, and between my husband and I, we make $100,000, I'm going to fall in the 22% tax bracket. So you can find where you're at. It's important to know your tax brackets, because if you are in the 10 or 12% tax bracket, your capital gains rate, so if you had an asset and you sold it as a gain, whether real estate or an investment, and you stay in the 10 or 12% bracket, then that tax rate is 0. So it's critical as you start thinking about which investments to use for different purposes, how is that going to be taxed? And the other thing about this is obviously US, well, maybe it's not obvious, but US has a progressive tax system. So it doesn't mean if I make 100,000, not all 100,000 is taxed at 22%. The first 19,900 is taxed at 10%, up to from between 19,900 and 81,000 is taxed at 12%, and so on. So you have a blended, or what we refer to as an effective tax rate, based on the real tax that you pay. And then, like I said, depending on the what tax bracket you're in will determine your capital gain tax rate. So once you go into that 22% income tax rate, your capital gains rate is 15%. And then if you're married filing jointly and you make over 501,000 in a year, it jumps up to 20%. And it's not that your income is that high. It could be that maybe you sell a business and that business creates a $500,000 gain. That's usually what ticks you up into a higher tax bracket. And if you're retired, there's a ripple effect. If you get launched into a higher tax bracket, guess a year later, your Medicare premiums are going to go up. And so there's a lot of things that we don't really think about in the moment, making a decision that what's going to happen down the road. How you saved your money. So this is the same slide from before. So how you saved your money in the accumulation mode is how you're going to pay taxes on the other side. So if your money's in a Roth in retirement, that's not showing up on your tax return. It's tax-free. If it's in all 401k money or traditional IRA, every dollar that comes out of that is taxable. So if all the money's there and you need a one-time purchase to do something, it's all going to be taxable. And then held in the taxable account, that's going to be, you're only going to pay gains on what you invested. So if you invested 10,000, you sold it for 20,000, you're only paying taxes on the gain in the year that you sell it. Okay, we're going to circle back now to the Roth conversion, because this is a very great tool that we can use for clients that are retired, that are in a lower tax bracket. So if you're in the 12% or lower, so if you're married filing jointly and your taxable income is about 80,000, which is really about 100,000, because we get the standard deduction of about 25,000. So if you're married filing jointly in retirement, making about 100,000, there's a sweet spot there where you can do Roth conversions. And it doesn't happen all at once, but you can do a little bit over time. Because if I can move money from a traditional IRA to a Roth, and pay taxes of 12%, taxes most likely will not be lower than that in the future. In fact, in 2025, they're already set to go back to 15%. So paying 12% today is a good deal. And then you get that money into the Roth and you grow it tax-free in the Roth. So there's some really great tip or strategies that we can use if you retire early, or if you have assets outside of your traditional IRA that you can live on while we do these conversions. Another strategy that is often very helpful in getting income taxes down is what's called a qualified charitable distribution. So at the age of 70 and a half, if you're over 70 and a half, you can take up to 100,000 out of your pre-tax IRA and move that directly to a nonprofit, your nonprofit of choice. A lot of times this could be your church, it could be your in our community, it's our hospital foundation, it's our Samaritan House, it's the food bank. Like there's a lot of different great organizations that need help now. And if you move money directly from your IRA to that nonprofit, maybe you're already giving currently, but instead of moving it out of your income, you're taking it out of your IRA. That will satisfy your required minimum distribution, and it will keep it off of your tax return. So you do not have to claim that as income. You don't have to itemize deductions to get the tax savings either. So it's a very often overlooked plan. Okay, we've got some great questions coming in, but I'm going to actually wait so we can get through all of this, and we'll pick those up at the end. So the third component of the retirement trifecta is having a smart investment strategy, no matter which stage you're at. So I am going to hand this over to DJ, and he is going to take it from here. So I'm going to stop my screen share. Yes.
Yeah, I'll take over. And real quick, actually, well, I guess I can just talk like this. So the smart investment strategy, this can help you reach your goals quicker. You know, it can make your money last longer. So it's a really important piece of all this. So we're going to talk about risk reward. Let me share my screen. Nope, that's not what we want.
It shows your whiteboard.
Oh, that's perfect. Okay, good. That is what we want.
Yeah, do that.
Okay. So risk reward. Every investment carries some level of risk. Generally, like most things in life, the higher the risk, the higher the potential reward. And if it's a lower risk that you're taking, you're generally going to be compensated lower for that. That's just life in general. So we're going to talk about some various types of investments and their risk reward level. So let me draw. Oh, here we go. Don't judge my handwriting here. Writing on a screen. Okay. So here's our scale. On this end, we've got low risk and low reward. Over here, we've got high risk and high reward. Okay, so let's start on the left here for low risk, low reward. What would be the lowest risk and lowest reward investment out there? What do people think? Let's see.
Cash.
Cash, there it is. Cold hard cash. Nothing special about it. Cash is not going to grow. I guess there's no risk except potentially losing it or putting it in the washing machine or something. But yeah, it's not going to grow, so no reward. We got savings. Yep. So not much reward these days. It's safe, but you're not making much. What else? What would come after that?
CD.
CD, the lottery. That's a whole different scale of its own. So CDs and money markets, we're a little bit more reward there, and it's still pretty low risk. So what's something else you guys have? What about bonds? So now you're actually making some money, but there is risk involved. You're lending money. We're going to talk more about what a bond is. And there's also here, let's do this. There's other types. There's multiple types of bonds. So lower risk, lower reward might be government versus corporates. A little bit more risk, but a little bit more return. After that, let's see, we've got gold, maybe real estate. Okay. Stocks. I'm running out of room here.
Mutual funds.
Oops. Mutual funds. Yep. That would come in here kind of, maybe right in here. And again, with stocks, you have multiple types. So, large US companies, they've tended to be a little bit less volatile than small companies. However, you don't make as much. We're going to see that here in a couple of slides. One that I want to add here, given the times, but I can't write it. We'll write it down here. Crypto. That is some high risk, high potential reward or loss. So yeah, it's a relationship, and what you should be invested in really depends on your situation, what you're saving for, where you're at in your journey. So let me go back to the slides. I'll stop my share.
Want me to share?
Yeah, go ahead and go back to the slides. Okay, so let's talk about stocks and bonds. These are some of the most, basic investments out there. So when a company wants to raise some money, they want to expand, they want to build a new warehouse, they want to invest in themselves and grow the business, they have two options. They can issue new shares of stock. They can also issue shares of bonds, new bonds. So there's a big difference in how this affects the company and the investor. So stocks, you have that investor that gives money to the company and they receive ownership for that. So they're a partial owner of the company now. They're going to participate in the profits and losses with that company. If that company turns into the next Amazon, that share price is going to go through the roof and that investor is going to be rewarded pretty well. If that company goes out of business and you own that stock, again, you're an owner, it's going to become worthless and you're going to lose. So you really are, you're moving with that company. Now bonds, if you're an investor and you purchase a bond for a company, you're loaning them money. So the company itself is retaining all their ownership. You're just giving them a loan and they're going to pay you with interest, maybe 3%, 4% per year, and then they're going to give the money back at the end. So there's still some risk involved that they could default and not be able to pay you. But of course, a company is going to do anything they can to avoid that scenario. But that's the difference. So one's ownership, one you're a lender, and there's different levels of risk involved with each of these, and also different levels of reward. So here we have a graph of various types of investments. 1926 is as far back as we can go. So any history graph or chart that you're going to see of the markets, it's always 1926. Those top two lines, the blue lines, these are your stocks. They're also called equities. So the dark blue at the top, that's been the best performer over the last almost 100 years now. It's averaged just about 12% per year. Large companies, these are small US companies. Then you've got large US companies, and they've been still really great, averaging just over 10% per year. And you can see that $1 turns into almost 40 grand for small companies, whereas $1 turns into a little over 9,200 for large US companies. But you can see how choppy these lines are along the way, right? Lots of ups and downs. Over time, they do really, really well, but there's lots of volatility. It's going to be a bumpy ride. You can see right off the bat there, the Great Depression, that was the biggest pullback we've seen in the market. And then the Great Recession in 2008, you can see that one towards the tail end. Here in a year or so, we'll see the 2020 recession that's not shown here. But there's always recessions along the way. And so then as we move down the line, once you get into the orange and green lines, these are government bonds. So a lot less reward, but less risky. So you can see how smooth these lines are compared to the stocks up above, but you're not going to make as much. So $1 turns into $159 for government bonds, and then just outpacing inflation, $1 turns into 22 for treasury bills. These are real short-term government loans. So corporate bonds, that's not on here, that would be a little bit above the orange line. So they do carry a bit more risk than loaning to a government. So based on where you're at, if you're in the accumulation phase, you're building your retirement, you probably want to be close. Most of your money is up in those top lines, those aggressive investments that are going to grow really well. If you are in retirement in that distribution phase, well, you're a seller in the market. You got to be a little bit more careful. You might want to have some down in those lower lines. The other thing is, when you do retire and you start to shift to that distribution phase, it's not like you use all your money in year one. Hopefully you're going to live 30, 40 years in retirement. And so you can still have some of your money invested like you did when you were building your retirement, but not all of it. That may be the case when you've got 30, 40 years. So next we're going to talk about inflation. So this graphic makes me laugh. Basically, inflation, it's kind of been non-existent for the last couple of decades, but it's coming back quickly, fast, and everyone's talking about it now, right? Inflation is one of the biggest news stories if you read about this stuff. So inflation is the increase in prices over time. And average, it's been about 3% over the last 100 years. The last couple of decades, it's been more like 2%. So some inflation is good. It means the economy is growing, but too much can be a problem. And that's what people are concerned about today. You can see that by the graphic here, right? As inflation grows, it kind of sucks the wind out of the economy, and it can be bad. So there's a sweet spot, kind of in that 2-3% has been ideal for the economy. Now, there are a number of factors that cause inflation, and the two big ones right now are money printing, as Julia was mentioning before, so much of this last year, and then also increases in demand. With the opening of the economy, we're opening everything back up. Everybody's out there, spending money. As demand outpaces supply, prices go up. So basically, you have more people fighting over the same number of goods. You're going to end up paying more for those goods. So that also has an effect on inflation. So we're kind of seeing both of those at play right now. We don't know exactly where it's headed. The Federal Reserve, or the Fed, is our central bank. And their job is to maintain a stable and growing economy. That's what they do. They have a number of tools that they can utilize to make sure that we're growing at just the right pace. Not too hot, not too cold, just right. Their two main tools that they control are interest rates. They can just change short-term rates. And they also affect the money supply. And that's what they've been doing a lot of. When we closed everything last year, they slashed rates to essentially nothing. That helps push the economy along. They also started pumping the money, or the economy with money, and it's called money printing, right? They don't actually print it these days, but it's increasing the money supply, and that's like a band-aid for the economy. It helps push things along. But the worry now is that, okay, we're starting to reopen, we have all this aid coming in, is it going to overheat and we've gone too far, and that can be a problem. So the Fed, they think that most of this is temporary. It's called transitory, meaning it's mostly from the opening of the economy and all this demand that's happening, and there's some supply chain bottlenecks, and they think it's going to likely stabilize around 2%. Nobody really knows what exactly is going to happen. I guess we'll find out. They are hinting at potentially pulling back some of this aid that they've been providing. They haven't done it yet. They're still helping boost the economy along. We're going to see, but they are starting to hint at that. So that's where everyone's eyes are at. What's the Fed going to do? Hopefully they get it right. Now, the key here is we can't control it as investors, right? What's going to happen is going to happen. What we can do is we can be prepared for anything. And the best way to counter increased inflation is a well-diversified portfolio. You know, you want your money to be spread out. You don't want to be just focused on one asset class, because inflation does affect different types of investments in different ways. And so that's really key. You know, be well diversified, own lots of different stocks, own bonds if you're using money. And that can be the best way to set yourself up in case inflation does go up.
Yeah, I know one of the things that DJ and I have been working on is specifically to bonds, the right type of bonds in our clients' portfolios. Because if we have inflation, that's one asset class that you have to be concerned about. So we are on top of that. And I also want to say in an inflationary periods, real assets do well. So look at the real estate prices across the country and how those have increased over the past year. The stocks, the investments, specifically more value-based investments, you know, those do well in inflationary periods. So I think that was fantastic, DJ. Just the story that you have to be a lifelong investor. You don't get to the finish line of investments. You make changes along the way, what's appropriate for you and your risk tolerance and your needs, but you don't ever abandon it. So really good. Thank you very much. Okay, as we come to a close here, I wanted to share a little case study. We recently wrote an article for Forbes, actually, and I'm going to have, if Sammy's on here, I'd love for you to put the link to our Forbes article. Oh, there it is. Ask and you shall receive.
Quick.
But we've seen this happen. I think it's because we want those dream homes, and it is really important to get you those dream homes in retirement. But here's what we want to talk about. It's not appropriate to use pre-tax retirement accounts to buy your dream home. And this is kind of a wrap up of everything we've talked about today. So if you think of two different scenarios, one that use their retirement accounts to buy their dream home, and one that use their assets that they grew in a taxable account. So, you know, whether it's the scenario I'm thinking about, it was a stock or mutual fund investment that they were only going to pay capital gains on it, not ordinary income. And the big difference, maybe their accounts were the same, but the difference is the way that you're taxed. So again, as a recap, if you pulled $500,000 out of your pre-tax retirement accounts to buy your dream home, you would at tax time get a bill for $200,000. And that is federal only, not state. So you have to then take out an additional $200,000 to pay taxes on it. That is just a big hit to your retirement account, and then also be prepared for increased Medicare premiums in the future. So just beware. Oftentimes it's better to get like maybe a shorter term mortgage and take annual payments from your retirement account, if that's your only option, to pay the mortgage for that retirement home. Oftentimes this could even be like a second home as well. Another option would be to consider a Roth IRA. So if you have Roth accounts that are accumulating or have accumulated, you can access those without paying taxes again. So it's powerful when you start thinking about major purchases and taking big chunks out of your retirement accounts. You have to look at what is the most tax efficient way. And then the other option is looking at non-retirement accounts. So that first bucket, because that would only require capital gains on the sale of those assets. But it's important that we get you that dream home. So we will partner with you to help you, whether it's a home or a vacation or whatever it is that you need. Work with an advisor that can help you create that most tax efficient plan to make your dreams happen. We do not want to drain your hard-earned retirement accounts if there's another way to do it. All right, so next steps here. So if we have talked about something that you would like to talk to an advisor about, if you are new to us and you want to schedule a complimentary consultation with one of our advisors, you can text the word freedom to 458-777-4458, and that will prompt you and then ultimately give you that scheduling link to schedule that appointment. We'd be honored to partner with you to help. We also have a really great new resource on our website, and it's the 2021 Tax Reference Guide. So it includes the tax brackets, the contributions that you can make to retirement plans. It's a wealth of resources. So if you would like that guide, you can text the word tax to 458-777-4458, and we will get that over to you. So we are happy to provide these resources to you and really help you win that retirement trifecta. We are partnered with LPL Financial. The LPL stands for Linsco Private Ledger. It was two firms that merged back in the 80s. We are the largest independent broker-dealer in the nation. We do have SIPC, which is Securities Investors Protection Corporation, for $500,000, which just means if LPL were to fail, that your money is protected. And they also have private insurance up to $575 million. So they are solid against insolvency. That's important when you're looking to partner with a custodian. And then all of our licenses with our advisors they're held with LPL Financial. Before we get to questions, I'm gonna let you read the important disclosure slide. But I've seen some great questions come in, so we will now take time to answer these questions. So I will stop the screen share here. And we'll start with the first one here. Is there a point where it would be beneficial to convert some of your taxed IRA funds to a tax-free IRA and take the tax hit early, knowing that future taxes will rise in the future? Yes, this is definitely something to consider. It would be what I refer to as the conversion. So you'd be converting from traditional to Roth. It is definitely a good decision if you are in the 12% tax bracket or lower. But if you are in the 22% tax bracket, then it becomes more of a conversation of what do you think your tax rates will be in the future, and to see if it makes sense to do it or not. So that's more of an individual. If you're married filing jointly, making over 100,000, then it's more of a one-on-one conversation. If you're under 100,000, then it's definitely a good strategy to consider. Okay, how do annuities play in the retirement plan? How many percentage? Okay, that's a good question. So annuities are investment vehicles that essentially can create income in retirement. So it comes down to the individual investor and their risk tolerance, number one. So annuities, when DJ did that risk reward, annuities are going to kind of fall lower risk because you're essentially transferring the risk to the annuity company to provide you some guarantees for the future. But in exchange for that, you pay more in fees, and you're most likely going to get a lower rate of return because you're transferring that risk. Do you have any thoughts about that, DJ?
Yeah, so it's almost like creating a penchant for yourself. And there's instances where it makes sense, but it is very unique and situational.
Yeah. Yeah. It's part could fit into the overall plan. Let's just say that. Yeah. Let's see. If I earn too much for a Roth IRA and everything accumulated so far is either taxable or tax deferred, would it then be prudent to use some current savings or investments to buy municipal bonds? Potentially. I would also say there is something called a backdoor Roth IRA, which means that if you earn too much, which is about, what is it, 200,000 for couples and 120,000 for individuals. If you're married, filing single, if you make over that, the government says, hey, you make too much money to put into a Roth, but there's a way to put it into a non-deductible IRA and then immediately convert it over. So there's some loopholes there that we'd be happy to talk to you about.
Yeah, and the Muni Bonds, that would be more for taxable assets, like non-retirement accounts. You want to be fairly conservative with it because it's still a bond, and your income's high enough where you would like to receive that interest tax-free. So that it's more of a conservative investment, whereas, like a Roth conversion, that's going to be, for my future way down the road.
Yeah. Another question, how does the annuity play into the tax planning categories? Okay, so you can have an annuity that is non-retirement account, so that would be in that taxable bucket. And then you can also have an annuity that is qualified, which is in that pre-tax bucket. So a lot of different ways that you could hold that annuity. How is an accident, award, or settlement taxed? How can that be turned into Roth or not because not earned income? Ooh, that's a good question. So it's not taxable. So if you received like an insurance settlement, that is not taxed. So you have now a nest egg to invest. If you did have earned income, then or your spouse had earned income, then you could use that money to put into a Roth. If not, maybe you're on disability or something, then you could actually invest that in a taxable investment account using tax efficient funds. And that would be a way to grow it as tax efficiently as possible. Good question. If I were to spread retirement investments over large companies, small companies, and mid-sized companies, what would be a reasonable percentage for each? Ooh, I'm going to let DJ answer that one.
So it, again, it's situational, depends on where you're at. For somebody who's maybe 25 and they've got 40 years till they're going to use this money, having 25% small, 25% mid, 25% large, and then you'd also want some international in there as well. You could do 25 there. That's a real aggressive allocation. If you're closer to retirement, you still want all of those in there, but you start to overweight more towards large US companies. So, maybe you have 10 in small, 10 in mid, 20 in international, and the rest in large. So again, it does depend on where you're at and what you're saving for in your time frame and your risk tolerance. As we know, small companies are going to be more volatile along the way than large.
Very good. Yes. All right. Well, boy, that was a lot. We were over the hour here, but great questions, everyone. Well, thank you for attending our webinar. Please be on the lookout. I know in the next month in July, can you believe we're going to be in July already? We are launching another series of our 5-day retirement ready challenge. So that will be coming up in mid-July. And then we also have a special guest speaker. The LPL economist is actually going to join us in July for our webinar, talking about the second half of 2021, what to expect for the markets, and beyond. And my guest is going to talk more about inflation.
I'm excited for that.
Yeah, me too. All right, everyone, have a beautiful day, and we will see you next month.
Bye.